Good morning. I'm Mehdi Sunderji and welcome to OETV. It's 9 a.m. on the Tuesday after a long weekend, and we're here with Jeffrey Hughes, founder at Alpha Insights. Jeff, welcome back, sir.
Great to be here, Mehdi, as usual.
So, firstly, I hope you had a wonderful long weekend. I'm sure you were quite busy judging by this piece. You put out your mega monthly piece, and there's lots and lots to cover. And the week has certainly been, well, last week was a lot of red. We're right now looking a touch more positive, but let's dive right into your piece and see what's going to happen.
Sure. If we think about it from a top-down perspective, what we're looking at here is an S&P that peaked on August 16th. We think that was the end of a bear market rally. That was the second large bear market rally in this decline. And we think the rollover, which is now retraced about 61.8% of that bear market advance, is teetering on the edge of just utter collapse, basically. We think this rollover is going to be a serious decline. And, we're getting a bit of a, kind of hooray, we're back to work bounce as, the big boys get off the beach and come back to their offices with, hopefully a bunch of new ideas in their heads. But I think the main idea is going to be we need to lighten up equity exposure going into the fall. And I think that's exactly what you're going to see over the next, 6 weeks, maybe 8 weeks or so, there's just going to be a persistent, amount of selling pressure that accelerates into the late fall, and I don't see that changing until possibly after the election.
So, Jeff, you've certainly been quite consistent on your views over the last several months, and one of the charts you have referenced has been pointing to a potential financial crisis. It feels like this is still potentially looming.
I think it is. I mean, we did get a bit of an uptick on this, but certainly haven't, recovered from where we came. And this really takes a look at a lot of interest rate sensitive sectors and compares them to a lot of interest rate proxies, things that are going to, basically go up with rates. And, when we compare these two baskets, we see that we're still kind of in that trouble zone. And our suspicion is at this point that, this is going to play out poorly for the bulls, put it that way. One of the things we've been thinking about in terms of where the risks are, so to speak, is just kind of the setup and positioning. Households are very overexposed to equities on a historical basis, but hedge funds, on the other hand, have positioned very, very net short. And this is very similar to the 1987 setup, where portfolio insurance was extremely popular amongst institutional investors. And what they did is they basically said, well, we're going to hold this core basket of long equities, but we're going to put some money with hedge funds that are going to short equity futures if the market goes against us. And that is basically exactly the setup that we have right here. And the way that worked out was that every time the market started to break to the downside, this cadre of hedge funds continued to short more and more equity futures. And as a result, it put more pressure. In fact, the portfolio insurance that we describe here really caused the crash of 87. And we're not necessarily predicting a crash, but we're also not ruling it out. The setup is very, very, precarious, put it that way.
So, Jeff, let's have a look at your risk allocation, because you're at 80-20. You're now in a neutral zone of 50-50.
Yeah. So we downgraded that to 50-50 on June 30th, recall. And so that really was a function of the stock bond ratio breaking down below our neutral trigger. Okay. And, what we do is we look at a broad swath of equities. We look at the S&P 1500 divided by the same corporate bonds of those same companies. Okay. So we're looking at what's better, their stocks or their bonds. The breakdown was such that it was pretty definitive when it occurred, but we have seen a rally back in this ratio. It hasn't quite moved out of the neutral zone, though. And I think, one of the issues is we've seen rates back up again recently. But during that period of time, stocks have actually underperformed bonds more than rates have backed up. And so we haven't seen it reverse. I think, we're very close to seeing that. And if we're wrong about equities in the fall, by this time next month, we should see this back at, a risk on signal and probably back to 80-20. I'm not anticipating it, but we did get very, very close. And so that's the reason why that occurred.
So just to clarify, would you expect us to be going to 2080 fairly soon in your time horizon?
Not 2080. I mean, unless the market utterly crashed. If you see that series of red dots that's advancing on the chart, that's the trigger to go to a 20% equity exposure. So that would imply a structural collapse in equities, and we're just not there yet. Even a 50% decline probably wouldn't trigger that. 50% decline would just kind of bring us back into the 200-month moving average. When I say 50%, I mean from the peaks. And so that's kind of where we've been targeting, that 200-month moving average as being kind of a level at which equities will likely find some durable stability for a more durable rally. We don't expect to see that level achieved until probably the first quarter of next year, although it could happen sooner.
And you've been consistently talking about the midterms being quite a pivotal point in timeline. Is this still the case?
No doubt. This is a historical cycle that looks at midterm election criteria, and the one that we're focused on is that kind of red or orange line, and that illustrates really what to expect out of the S&P 500 based on all of the historic occurrences in which a new Democratic president in his first term approaches the midterm election cycle. And so we have that situation right now, and so we should expect that to play out. I'd also point out that the one-year seasonal cycle is exceptionally weak into the end of October. And we've been highlighting two cycle turn dates based on the work of Paul McCray Montgomery. And those dates are October 25th and November 8th, the election day. And it's our view that because these are major cycle turn dates, and because seasonal and the midterm election cycle both point hard down into that late October timeframe, that we think we should expect a bottom probably on or about October 25th. And if in fact we don't get a bottom there, it might extend to November 8th, but that's kind of the window that we're looking at. We would expect the market to put in something of a durable bottom that we could trade, right? But not the bottom. So we're not looking for the market to put in its ultimate bottom there and then take off to a new bull market. We just think a tradable low will be in place come October 25th.
All right, so you've given us some of the timeline to expect over the next few weeks, months. What about some of the levels? How do the technicals look?
Yeah, so the technicals don't look great. Our preferred count suggests that we're in the very early stages of a 5-wave motive wave decline, which is part of a 3-wave supercycle corrective waveform. So a corrective waveform would be 3 waves, an A, a B, and a C. The A wave would be 5 waves down. The B wave would be 3 waves up, and the C wave would be an additional 5-wave decline. We are in, we finished wave 2 of a 5-wave decline of wave A down. So we're so early in this process. And this might baffle a lot of people thinking, well, the market's down 24.5%. That's a pretty good correction. Not at super cycle degree. We're correcting a bull market that began in 1932 based on our calculations and terminated on January 4th. That was a 5-cycle degree or a 5-wave cycle degree advance. So the entirety of that 32 to 2022 periodicity, that 90-year cycle, was a super cycle. And that coalesces with what W.D. Gann wrote about cycles as well. There was a 30-year, a 60-year, and a 90-year cycle, and this is the 90-year cycle that peaked. And so, we're looking at this as likely to be a very, very large degree correction that takes years to completely play out. Now, if we're correct on where we are in the initial, subdivisions of this supercycle degree corrective waveform, we're just beginning primary wave 3 down of cycle wave A down of supercycle wave 4 down. And so that's a very, very, precarious position to be in. And we think if that plays out, we'll see a very rapid, powerful decline into levels that could be around the 2750 on the S&P 500 by late October, as we've described. Following that, we could see a reprieve, something of a lateral consolidation before the next decline, which could carry the S&P down to that 200-month moving average level, which would coincide with about the 61.8% retracement of the 13-year advance off the March 2009 low. That gets us to about S&P 2250, and that would be our ultimate target for wave A of supercycle wave 4 down. From there, we'd be looking for a fairly sizable bounce, and that would be a late 2023, 2024 type event. Now, if we're wrong about that, we'd look at the alternate count. And the way we'll know that we're wrong is the market will take out the August 16th high. And if that occurs, then we have to assume that we haven't reached that terminal point of the supercycle wave 3 that we just described, that we're still advancing in cycle wave 5 of supercycle wave 3. And so that would put us around intermediate wave 4, which would likely be a lateral consolidation, most likely a symmetrical triangle. And if that's the case, then we're probably somewhere in the midst of wave B of a 5-wave symmetrical triangle A, B, C, D, E, which could take many months, possibly more than a year to complete. And so once we do complete that, we would expect a thrust to new highs sometime, more than a year from now. And that could carry the S&P as high as 5,400. We would ascribe a probability of around 10% to that alternate and about 90% to the preferred count. But if we did take out the August 16th high, then I would suggest that those odds would go closer to 50-50 at least, and possibly 60-40 in favor of the alternate count.
Okay, so there's at least a moving target here. It's not all potentially doom and gloom. This is obviously your big monthly piece. You examine a lot of different asset classes and portfolio rebalancing. Looking at some of these asset classes, is there anything that stands out?
Well, the thing that stands out the most is that none of them did particularly well. Both stocks and bonds were equally poor performers in the last month. One asset class that we're really not illustrating in this chart is cash. And if we think about cash as the US dollar, that has actually been the best performing asset of major asset classes this month. It was up something like 2.73%. Now, if we think about long-term performance, looking at the last 12 months, commodities have actually dominated. And that has been, I think, largely due to agricultural commodities and also energy, although I would say that energy took it on the chin a little bit in the most recent month, with crude oil being down some 9%. But natural gas has been very, very strong. So, the energy complex is more diverse than just WTI crude.
And Jeff, over the last several months, over a year now, I guess, we've been talking about value versus growth and growth versus value. Do you still prefer value over growth at this point?
Well, there's no question that value has been outperforming growth over the last 12 months. In fact, large cap value of the three kind of Russell style boxes, if you will, is the only of those style boxes that has produced a positive return and has smartly outperformed growth, large cap growth, on the flip side by about roughly 2,900 basis points. That being said, in the latest month, both large cap growth and large cap value performed equally poorly, both down about 4.5%. Where the real outperformance came was mid caps, and both mid cap growth and mid cap value again outperformed their larger cap and smaller cap peer groups smartly by hundreds of basis points. But within that, it was actually mid cap growth was the stronger of the two. But in aggregate, value has outperformed growth over the last 12 months, and we would continue to favor that as leadership going forward.
And how has overall market participation been?
It's been terrible, frankly. We've got a bit of a bounce off the absolute lows, but less than 25% of all U.S. stocks are currently trading above their 200-day moving averages, and that occurs in an environment when where actually new lows continue to outnumber new highs on a monthly closing basis. And so, we think that this low participation is a drag on the overall stock market going forward.
Well, on that note, you're also looking at net new highs, which indicates, I guess, further downside as well.
Yeah, we've divided it between the NYSE and the NASDAQ. NYSE is on top, and that's done better than the NASDAQ. It's actually holding its chart support level, but has breached its trend line support. I would point to NASDAQ as really kind of leading the crowd down. There are more NASDAQ issues, about 3,600 versus about 2,200 in the NYSE. And, we've seen a breach not just of trend, but also chart support. And so, both of these measures are pointed down and to the right. And that is not consistent with a new bull market. Usually cumulative net new highs tend to be a coincident and then leading indicator for price. And we're not seeing anything indicating higher price from this chart.
I also feel like your advanced decliner lines are painting the same picture.
Yeah, they're both in downtrends. There's no question. On the left-hand side, we're looking at the NYSE cumulative advanced decline line. The top frame is the NYSE composite index, and the bottom frame is its AD line. And both have turned down from their recent bear market high, but we did not see a recovery above what was chart support and is now chart resistance. In fact, both are trading below their 50-day moving averages. The NASDAQ looks worse. In fact, if we look at the NASDAQ composites AD line in the bottom right-hand frame, that really is, kind of giving us a strong indication of where the market is headed. It has rallied back into a declining 50-day moving average and has rolled over hard down. And our suspicion is that that is a good indication of where stock prices are likely to go going forward.
Jeff, we also, August is always silly season. People are away. It's all quiet. So we saw some pretty low volume days in throughout August, especially the last couple of weeks. Can we expect to see that changing in September?
Well, I think volume will increase, but it doesn't necessarily mean that it's going to be advancing volume. And what we're looking at here, whether it's a light volume or a heavy volume, we're looking at the cumulative net advancing volume on both the NYSE and the NASDAQ. And on the left-hand side, you can see that the NYSE had been in a long-standing downtrend going back a couple of years. And we actually rallied up into that trend line and took out chart resistance and trend line resistance, but that failed and rolled over hard down. And looks to me like it's the dominant feature here is that net advancing volume is really non-existent. We've got net declining volume. Now, if we look to the right-hand side, we're looking at the NASDAQ, which has been a much, much stronger chart. However, when we look at the most recent, weeks and months, actually going back, say 3 months, we could see that we put in a series of lower highs and lower lows here from the peak in June. And so my suspicion is that over the last 3 months, we have seen deterioration enough to suggest that the NASDAQ's net advancing volume chart here has peaked and is now rolling over. We'll be much more confident in that statement once we take out chart support and moving average support.
What about volatility? That was always on the rise the last couple of weeks. We're going to see the same now?
I think so. I think we're at the precipice of a volatility spike, something of a reprieve today. But we've seen this negative, or I should say, positive divergence coming from the VVIX, the volatility of volatility. So as VIX itself made its 10th weekly low into mid-August, the VVIX had actually bottomed in late July and had turned up 2 weeks prior. And that positive divergence is, a strong leading indicator of a reversal in volatility. And those reversals tend to be stronger if volatility is above 24%, which over the last 5 years or so has kind of been something of a boiling point for volatility. And once we get above both the 21-day moving average and the 55-day moving average, then I think volatility is in a good position to accelerate to the upside. So we've got all those conditions in place. We've got that, bearish to bullish reversal signal, and then we've got the boiling point, and we've got the moving average trend lines turning up, and volatility has turned up to the upside. So our suspicion is that we're going to see volatility north of 30% and possibly north of 40% as we move into the next 6 to 8 weeks. And bear in mind that if we look back over the last 2 years, volatility hasn't made, it hasn't broken out above 40% in over 2 years. And so, our suspicion is that we're going to see that change in the next 6 to 8 weeks.
So that starts screaming fear. What about the put-call ratios? That generally highlights some investor sentiment one way or the other.
Yeah, and what it says is that there's no fear in the market. Normally if there were fear, these are 10-day moving averages of both the equity put-call ratio on the top frame and the total put-call ratio in the bottom frame, which includes index options as well. And what we're seeing is we got to kind of a neutral level, almost like a dead on balls neutral level, right? And we've rolled over hard down again in both of those measures, suggesting that complacency has really been the overwhelming factor here within the put-call ratio. We're not seeing a lot of put buying on individual equities or on the markets at all. And so there's less hedging, and that might be because people have decided that we don't trust volatility to deliver, and so we're just going to outright short equities in the futures market, and that's definitely shown up in the positioning. But the put-call ratio has been historically a pretty reliable indicator of fear, and there's just really no indication of fear in the market whatsoever here.
And Jeff, how's margin debt playing into everything? Is this starting to come back?
Margin debt's interesting right now. So the bear market rally actually reversed the decline in margin debt. We saw the first uptick in this calendar year. We actually saw margin debt expand $13 billion in the month of July. Now, bear in mind that margin debt's reported about 30 days in arrears. So we won't find out what happened in August until we get the September data, which won't come out until October. But from what we can see here, this uptick barely moved the rate of change from minus 22% to minus 20%. And that continues to be a concern because we did not see margin debt bottom, and we didn't see the market bottom until this rate of change got to negative 40 to negative 50%. In the last two big bear market cycles, the 99 to 2002 bear market cycle and the 2007 to 2009 bear market cycle. And so I think that we're, some distance from finding the bottom in the rate of change for margin debt and also the bottom in stock prices.
And Jeff, you've been consistent recently saying that valuations in the market are too high. Is this still the case, or are things coming in?
They are. They're way too high. In fact, from a historical standpoint, the market's trading around 29 times on a Shiller Cape ratio basis, and that's still well above where we had been historically at market highs. In fact, if we go all the way back to 1929, for example, the market peaked at 31 times in 1929. So we're only 2 multiple points below the 1929 peak. Now we're well below the 2000 highs where we got to around 44 times, but the average is 17.3. And so, we're 70% above the average at the current levels. Given that, I think we have to be cautious still on valuation. From a market cap to GDP perspective, we're at 160% of GDP. The market peaked around, I think, about 210%. So that's down from the all-time peak. But if we look back at the 1999-2000 all-time record high, at that time, it was 142%. So we're still about 20% above the 99-2000 valuation peak when it comes to market cap to GDP. I think that this just should leave investors concerned about valuation, and they should be definitely dotting their I's and crossing their T's with respect to valuation when making an investment.
And well, that obviously puts concern on the overall economic growth. How are we feeling on that? This almost looks vaguely positive, though.
Well, and it always does about this time in the quarter, right? We're early in the quarter. The quarter will end, in another 3 weeks or so. But there's a lot of data that comes out in the next three to 4 weeks, and in fact, they continue to adjust this right up until the date that it's reported. So because a lot of the data is lagging, so we're not going to get September data until October. So essentially there's about an 8-week window here before we're going to see third quarter GDP reported. Now, this is the Atlanta Fed's nowcast, and it looks at data points in real time and then extrapolates them, based on the trend of all the data points to come up with something that looks like a decent estimate. And they're estimating 2.6% real GDP growth. My suspicion is a lot of that has to do with the fact that we've seen a decline in energy prices from their recent highs. And, there's a strong expectation that inflation has peaked, and that may very well be the case. It just doesn't mean that we're going back to, low inflation levels. Inflation could remain persistently high in the, say 4 to 6% range for some time to come. It doesn't necessarily have to be 8 or 9% in order for us to have a sluggish real growth environment. And so, we've been kind of discussing this idea of rolling recessions. We've got a couple quarters of negative real output in Q1 and Q2. It looks like Q3 is shaping up to buck that trend, but we'll find out. Stay tuned, right? Because it's not set in stone at this point. But even if it does post a positive number, it really just plays into that rolling recession idea where, we're coming out of something, but it doesn't necessarily mean that we're not, that we're coming out permanently. It's showing up in, services PMIs, manufacturing PMIs, housing data, which is 18% of the economy, is imploding at this point. So I can't see anything good. And the only thing that's really supportive are earnings estimates at this point. And let's keep in mind, they're still estimates. We have 2 quarters of earnings yet to be reported. And our suspicion is that those estimates are going to be revised markedly lower before year end. I don't think that there's any possibility that the market can put up a number of 225 for S&P operating earnings this year. I think that number will be south of 200 when the rubber meets the road. And we'll find out in some time. We've got a good 6 months before that data is going to be in our hands.
And you touched on inflation there. If we peaked on inflation, are we heading in the right direction? Obviously, we might not get back to 2%, but are we at least going in the right direction?
In aggregate, no. In fact, we saw about a 13 basis point increase in the 9 different measures. We take 9 measures that the Federal Reserve Banks, 9 Federal Reserve Banks, all do their kind of independent calculations of core CPI. And these core inflation measures, when we aggregate them and divide by 9, have been coming up with something like 300 to 400 basis points above the Fed's 2% target rate. That's core inflation. That does not include volatile food and energy prices. And so when we think about it, last month it was 259. Last month it was 359 basis points above target. Now it's 372 basis points above target. So in aggregate, no. But the Fed's preferred measure of core inflation is to focus on this core PCE, right? This is the consumption expenditure, right? Personal consumption expenditure. And so that measure actually downticked from 4.8 to 4.6 in its most recent reading. So some would look at that as being, a marked positive. And I don't disagree with that. It's moving in the right direction, right? But it's not the only measure. It's just one measure. It just happens to be the one the Fed seems to have the highest confidence in. And, we'll see. It's been volatile. It's gone both up and down in recent months, and there's no reason why it couldn't go back up at the next reading. But, there isn't a trend, right? It's been coming down from its peak, but it's been ratcheting back up. So, we'll see. Stay tuned.
And Jeff, so how does that position us for the Fed? Do you expect 75 basis points again?
I do, and the street does as well, right? The most recent reading shows there's about 59% probability on the CME Group's Fed Watch tool, where they're basically looking at Fed futures and and calculating out the probability that's baked into the market itself. And the market basically is saying there's about a 59% probability that the Fed hikes another 75 basis points. Now, what's interesting is, we mentioned 87 earlier. Back in 1987, in June, the Fed funds rate was about 6%. And then you had Alan Greenspan, the new Fed chairman, coming in, and he wanted to show that he was tough on inflation. And so he hiked again. And we saw basically a 238 basis point increase off of that June low to about 8 3/8% by September. That's about the same as the 225 basis points that we're seeing the Fed increase in June, July, and now September, right? If we get that follow-on 75 basis points, about the same absolute terms increase. The big difference was it was a 40% increase in 1987 from 6% to 8 3/8. We're going from, basically 100 basis points to 250 basis points or from 50 basis points to 250 basis points in a fairly short period of time. I mean, that's a tripling of the Fed funds rate over the same, 3-4 month period of time. And so the impact on the economy is going to be so much more dramatic, right? It's really, we're not seeing the real effect of this tightening yet in the real economy. And that's why I'm reticent to make the real comments about inflation or growth without the data, because it takes a good 6 months for these Fed hikes to impact the real economy. We're seeing it impact mortgage rates immediately, right? And mortgage rates are back around 6% again, their June highs. And that's having a major impact on 18% of the economy. But, the rest of the real economy is yet to really feel the full brunt force of this Fed tightening. And so I think that's yet to come. And that's why I would not be particularly bullish about what we're seeing in the Atlanta Fed's data for third quarter GDP just yet. And, it could very well quash inflation. We could very well see inflation data contract, but I don't think we're going to get anywhere near 2% or 3% for that matter. So we're a good 300 basis points above, where we need to be in terms of really battling inflation, subduing inflation. In fact, you heard John Williams mention it. He was quoted in the Wall Street Journal last Tuesday saying that he thought the Fed funds rate had to reach positive. It had to be positive in real terms, which means it has to be above, the CPI inflation rate, the headline number. And that's, they're a good 300 basis points behind the curve. So yeah, the answer to the question is they need to raise 75 basis points in September. The sooner they do it, the better.
Okay, hear that. Jeff, you obviously did your monthly piece, as we've discussed, and you've got a breakdown of sector leadership here. How would you look to position yourself? Any sectors that you'd like to get overweight?
Yeah, we kind of look at the top third or top 3 or 4 in our rankings here as being where we're going to be overweight, and the bottom 3 or 4 is where we're going to be underweight. In this case, energy ranks number one, and we can see that it's a standout, no doubt. We also like some of the defensives like utilities, staples, and healthcare. Although healthcare did get a downgrade for technical reasons, but it's still on a relative strength basis worth taking a look at. Energy, on the other hand, is really the standout and the one that we need to be most concerned about because it has been the leader for the trailing 12 months, no question about it. It was the leader last month, and it has got the best relative strength profile. The problem is we're kind of vacillating around that point where it could go from bullish to neutral, right? And we've already seen a breakdown in crude, so we're getting some mixed signals here. We actually downgraded our view on crude oil from bullish to neutral because we saw a pattern develop that we would commonly refer to as three black crows. The last 3 monthly bars were black and overlapping, and that's usually a bearish reversal pattern. And so the data is inconclusive at this point, and so we want to be neutral as opposed to negative on oil. We're very bullish on nat gas, and there's a lot of nat gas in the energy sector. Exxon, one of the largest companies in the space, is heavy nat gas, and so we like what's going on at Exxon. We like what's going on in nat gas. We think energy is over. It's undersupplied for the amount of global demand that there is right now, and we think that that's not going to change anytime soon. So we want to continue to stick with this bet, but at the same time, we are seeing some mixed signals in the underlying commodities, which can vacillate wildly and more volatilely than the stocks.
Thanks for that, Jeff. And also, we're obviously quite US centric here in our conversations, but you obviously looked at some of the global markets. Are there any external, global markets that you look at?
Well, look, we want to avoid Germany for sure. It's been the worst performer in our work. Other areas in Europe, like Italy, has been a poor performer. Netherlands has been a poor performer. But also both South Korea and China have been poor performers. So those are the areas that really focus for underweights. The overweight side, we like some of the commodity-centric countries, Brazil, because they've got a strong agricultural commodity-based economy. We also like Canada and Australia. But we also like some of the other more Anglo-type democratic economies, capitalist economies. India, for one, stands out in the emerging markets. We continue to see strong relative strength from India. And then we like the UK. And, there's a change politically going on there, which could, positively affect some of the economic dynamics underlying the UK. And so that's really where we're making our bets. And everything else is pretty much neutral.
Not too sure about the UK, but we'll see how that all pans out. What about from a macro asset perspective?
Yeah. Again, we mentioned crude oil, and crude was down 9.2%. Ex the cryptocurrencies, it was the worst performer of kind of the major macro assets. We did see basically everything except the dollar was down. The dollar's really kind of been the safe haven asset. There's been a lot of fund flows into the U.S., whether it's going into, the mega cap stocks like Apple and Google and Amazon, for example, as well as treasuries, right? Treasuries have caught a bit on the low end, right? Because we've got, higher low end or low part of the curve yields. I think the 2-year treasury yield is now around 340. And, even the 3-month treasury bond treasury bill rather is garnering a lot of flow. So money's coming to the U.S. and that's one of the reasons that the dollar's been strong. I think, the issue with crude is really, it got a little bit ahead of itself and it's more correcting that, excessive spike that we saw last March. It's kind of been in this, 3-wave consolidation. It's been, a large degree kind of lateral consolidation. It may be coming to a head. We'll find out, but we don't know for sure. And so, we downgraded it because we did get a break of what we described as key support. And, we're not going to let our opinions overwhelm the data. The data is really what drives our decision making here, and the data says that it's not conclusive at this point. So we want to be neutral on the crude.
All right, so let's get back to equities and how do we make some money in this market?
Well, we always like to have a top long and a top short to talk about. And in this case, we like kind of an old school play called Scholastic Corp. It's a publishing company. They make school books. And we're looking here at a large inverted head and shoulders base formation. It's a fairly large degree pattern. It dates back 5 years or so. And we're setting up for a breakout. There's no doubt about it. We've broken out above $47. If we can sustain that breakout, this pattern counts an upside target to about $74. We would set a stop loss at 43 to budget our risk here.
And what about on the short side?
Well, there's no worse chart in the big cap names than Meta Platforms, in our opinion. This stock has been in a downtrend for some time, but if we step back and look at it on a 10-year monthly basis, we're looking at a stock that broke its long-term structural trend. It's broken 2 levels of chart support and currently trades below the $165 level. I think it went out at about 160 last Friday. This chart, if it continues to fall, counts to about $100 a share, then much lower. The relative strength profile on a structural basis is horrific. There's none worse among the large cap stocks that we're following. And so, we would definitely look at a short position in Meta below 165 with a stop loss at 185, looking for a target of 100. If you're a long only, this would be a stock to avoid.
Oh, great for that. Thank you for highlighting that. And that chart does look quite ominous. Jeff, as always, I want to thank you for your time and thank you for running through us this mega monthly piece that you put out. I would urge our viewers to check it out. It's a very good in-depth read on how to portfolio position yourself or position your portfolio even. So until next time, Jeff, thank you so much.
Always a pleasure.
And I want to thank our viewers and the team at OETV for making this all come true. So until next time, good luck investing.